We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Lynch, aka Ditch the Deep State at Wall Street Silver. How are you today, Michael?
Good. How are you, Tom?
I'm excellent. So, you and I originally spoke, I guess it's going back almost a year now, last May. I kind of got in touch with you when I was reading all of your excellent and very in-depth due diligence reports over at Wall Street Silver. And at that time, we had kind of decided that an interview wasn't necessarily appropriate. But you got a hold of me recently again, and we've been kind of going back and forth over the data. And there's some real, aberrations in the Comex deliveries for this month. And you've highlighted some excellent kind of points in time along the way here. So why don't you start by giving us a little bit of your background of how you came to really writing up these reports?
Okay. I was never that involved with gold or silver throughout my adult life, but in the late 90s, excuse me, I was living in Indonesia. I watched the currency collapse and by about 90% or so. And I saw what can happen when paper, fiat, just gets destroyed. And that kind of piqued my interest in metals, true money. And I spent a lot of time researching the history. And it's surprising, none of that comes to you automatically. You've got to go find it. It's just not part of pop culture or finance culture to learn about the history of money. So that's kind of what drove me to metals. I've been a petroleum engineer for a lot of years and generally are pretty good with data. And I started applying at the data analysis, analytics to some of the Comex gold and silver data. And that was about 2 years or so ago. And I think I've found some interesting trends where you can glean what might be going on behind the scenes by watching the body language of the big players. Mm-hmm. And that's what I've got racked up here today. I thought your viewers might be interested in hearing that.
Mm-hmm. Yeah. So maybe we should also start by kind of clarifying some things. It's not necessarily that you're talking about a default on metal, because there are different ways to, effectively, as you put on the screen there, effectively default. And it's more about the price signal to the market, or the market psychology that a condition like this would send. Is that a fair way to say it?
Right. Comex will never default because they've got hundreds of pages of rules on how they can wiggle out of actually settling for metal. Mm-hmm. They can settle you in cash. They could settle you in PSLV shares, if you can believe that. And that's paper. There's no way you're ever going to get metal out of PSLV in lots of other ways. Or they can just shut the exchange down. The rules are they can change the rules. So there's never going to be a true by the book default. Mm-hmm. But what I call an effective default is you enter that marketplace, you intend to buy metal, and you don't get it. And you go through all the correct procedure, you don't get it. That's effectively a default. Mm-hmm. And I would say that probably happened here just recently, but it was buried behind the scenes.
Mm-hmm. And, we have touched on this subject many times before on the show, but why don't we run through a couple quick definitions like open interest, delivered, eligible, things like that, because we're going to be touching those terms here.
Yeah, good idea. Okay, so before I flip here, in case I forget to say, the big conclusion from all this is you cannot look at the price and to signal the market condition. That's just not valid. What's what's important is what's going on behind the scenes. And if some folks have seen Comex silver price stagnant and they think nothing is going on, but I'm here to tell you that there's a lot going on behind the scenes. So the price is not the signal. Okay, let's talk about some of the definitions and roles. Just spend a minute or so on this. Here's the open interest is just the number of contracts that are open for any single contract, or the total for all the contracts. So this is all through time. There's any slice on time down here, you can see there might be 5 or 7 contracts open. And there's the so-called minor months. Roughly, they alternate major minor months to keep it simple. And there's the so-called active or major months where the open interest peaks that on the major ones roughly 100 times higher, 80 times higher or so. But then is any one of these contracts roll, like let's just pick 2 of them here. So most of these folks that are buying contracts are just paper players. They're not going to buy metal, at least on Comex. So that they are just interested in having a paper contract, and most of them will just roll it forward, and most of them will just play the active months for that. And so let's just pick these 2. So about a year ago, March and May. So it's some moment in time, the March is the most active one. Somewhere at this point here, people start rolling. They sell this contract and they buy the front month, the 1-2 months in advance. So the open interest plunges on the one, and the incumbent rises quite a bit. So there's a trigger date here. First notice day is where if you're long on that day, that's roughly a month before the contract ends, then you're standing for delivery. So you've got to come off of you got to put up the full amount of the contract. And if you just hold that contract open, you're eventually one of the shorts is going to issue a delivery notice, and you're going to buy metal. So those are the basics. So there's the roughly 1 month period after you go to first notice day. Notice the incumbent month, that open interest is at its near max, and everybody's trading that. And in this final month of that contract life, these folks are generally buying metal, getting delivery, or they could close their position also. So those are the basics. But if we take all the contracts, these recent contracts, and just normalize the open interest to that first notice day, this is what it looks like. So generally they all get the same profile. Some of the contracts have an extra month before because there's 2 inactive months, so don't worry about that. But generally they build, they're on plateau, and they're all falling, and they plateau generally at different amounts. So, and there's something else to be cognizant of, that all this metal, once you hit first notice day, the metal is sourced from the registered metal in the Comex vaults. And so all the shorts have to have metal in that vault, in the registered category in the vaults, to be able to settle a contract. So the amount in registered during this time period here has varied from about 16,000 contracts to about 30,000. In fact, it's come down generally over the last year from 30 down to 16. So you can see this squeeze that occurs. I call it the limbo game. As you're coming down, just in the last 10 days or so, it's plunging. These contracts people are selling the contract, but at first notice day, generally that's when there's going to be a problem if you're not underneath the amount of metal in the vault for registered. So one other thing on this plot to point out is everybody talks about the ratio of the number of paper contracts to the amount of metal in the vault. And you could look at it here. If these contracts average, say, 130,000, and if there's 16,000 in the vault, then there's your ratio of paper contracts to metal in the vault. So any moment in time, you could divide that. And actually, there's other contracts open. This is just the main one. So that's kind of some basic jargon. And let's talk about one big incident that occurred in July of 2020. So let's zoom in on this final 7 days here. And more specifically, not just that 7 days, but that July 2020 contract. So this was an epic contract. There were 82 million ounces delivered on it, and it was a real squeeze play. So here was an open interest in the final days coming down. And on the last day, the one standing for delivery, it just barely, there were 16.8, say, let's call it 17,000 contracts standing, and there was 18,000 contract equivalent in the vault. So that was a squeeze play. Now, just because it's in the vault doesn't mean those 16,800 shorts own that metal. And in fact, they didn't, because this is what happened in that same day. You saw two big players, JP Morgan and would end up being a HSBC bank who vaults at CNT, apparently. They moved collectively, the two of them, 33 million ounces. With a click of a mouse, they moved it from eligible into registered. So that's 6,600 contracts equivalent. And there was no metal that moved into the vaults in the days or weeks in advance. These guys were flush with metal. They just clicked the mouse and moved that metal into registered, and they were able to settle. And so you can see what looked like a tight fit after that giant increase. Well, the vault total was actually sufficient, plenty. And by the players, they were able to deliver their contracts. So here's the issue and stops report for the same day. So the metal goes in, bam, and JP Morgan, the house account, delivers 30 million ounces, boom, just like that. Okay, and their friends HSBC, they had moved not quite 14 million ounces into the vault, but they had some registered apparently, and bam, they settle. The reason I bring this up is this is the way it was when Comex was and this is my interpretation, was flush with metal. They had plenty sitting around and eligible, and it's not that way anymore. And I'm going to get to that, but this was a big turning point in the market. So here's the silver price chart during that same period. You've got this pivot point here, that June 29th, where that 30 million ounces moved. So in the time before this, nobody knew it at the time, but JP Morgan was selling 30 million ounces worth of metal. They were selling the contracts for that, and they delivered them on that day. So they were, in my interpretation, suppressing prices all through here, holding it down. And after that, it was a whole new market. Just the next day, it was pretty active that next day. And over the next 5 weeks, silver ran up by 60%. So that's why I will say it's very important not to look at the price signal, but what's going on behind the scenes. This is one good example of that. And this is an example of what it was like in the flush days of metal in the vault. So to move on, here at Wall Street Silver, we call this the monkey plot. I forget why we call it that, but it tracks the amount of metal in Comex registered on this blue line, and also the Sprott PSLV physical trust. So let's track Comex here over. There's these 3 timestamps from the start of the COVID era, and the amount of metal in the register was about 80 million. Then we get to this time period here with JP Morgan with their 30 million transfer, click of a mouse. And afterwards, other metal still flowed into the vault. And it had gone from 80 million up to 150 million over about a year period. So let's track PSLV. So at the start of COVID, there was a bump in activity, and they added metal. So folks buy shares at PSLV, it drives it into a premium, and they're able to issue shares, and they take that cash from the shares and they buy metal. Generally, they do that within a day or two. Shares are sold, metal is bought within a day or two. And so then that JP Morgan was a big transfer, was a pivotal moment, because like I showed you, the price jumped right after that too. So a lot of activity, shares were bought at PSLV. And then in late January, early February was the start of the Wall Street silver squeeze, where several parties, you got Ivan at Wall Street Silver, you got the Happy Hawaiian, others initiated this initially at Wall Street Bets, and it went over to Wall Street Silver. And you see the impact on the amount of folks that were buying metal or shares and eventually metal, and Sprott Trust followed that trajectory. And there was almost a mirror image with what happened in Comex Register thereafter. Now, Sprott doesn't buy paper, they buy metal, and they don't buy Comex contracts and take delivery, because that'll never work. Someday somebody's going to get stiffed. So they deal with metal, not paper. If you want paper, go to SLV. They don't have metal over there. So you can see about a mirror image here. It was almost a 1-for-1. Metal possibly was bankers or vendors, brokers were moving metal out of Comex and then selling it to PSLV. That's the hypothesis. And so since in this new era now, I would say, so from, let's zero the meter on this, the new era after JP Morgan moved at 30 million ounces. And so since that time period there, yeah, the metal went up, but now it had fallen by about 40 million ounces. Whereas PSLV from that point, they've added 77 million ounces. And so that's quite a change. And now I'm going to show you examples, these other events that occurred starting in December here, just a few months back. And one thing to say on this run up here, to get ahead of myself, is that's about 17 million. That's what JP Morgan has added into the vaults in the last month, but they've already sold it. It's gone. So they've tracked down metal from somewhere, transferred it into registered, and immediately that same day issued delivery notes. They no longer own that metal. So there's a good chance it may well come out. So I'm kind of ignoring that run up here on this chart. But okay, so the next incident, I'll call them, is December 1st on the December contract. So here's what happened. This is very odd, odder than a UFO. So on November 29th, it was the first notice day for that December contract. Bank of America has been on a buying binge, and they're on day one, and they stopped, which means buys 734 contracts. 2 trading days lapse. The third day they issued delivery notices on almost 5,000 contracts. Well, that's odd. You go from being long 735 to being short 4,900. How did that happen? In fact, the math doesn't work. It's completely not possible. So in those 2 trading days in between, there were only 3,000 shares of volume, total volume on that contract. And in fact, there were no net contracts created. In fact, they shrunk. Mm-hmm. Some longs folded. And so how did Bank of America go from, and they might have, for all I know, it happened 734 contracts. They might have had another 1,000 that they were going to take delivery on. I don't know that. So at a minimum, they got delivery on all 735 contracts. But somehow, in 2 days, they go short 25 million ounces. Now, how did that happen? It's impossible. I don't see how. I haven't heard anybody come up with any explanation. Mm-hmm. So here's my theory, is that there was an off-exchange deal. Somebody had 25 million ounces of shorts and couldn't deliver it. or didn't want to, but probably couldn't. So, and my primary suspect is JP Morgan. So they couldn't deliver it, and they did an off-exchange deal with Bank of America and said, here's my shorts for 25 million ounces, and here's $600 million plus another X million for your headaches. Mm-hmm. And thank you. So in Bank of America went and settled them for them. So this seems incredulous, but I'm not making this up. Here's the issues and stops report. Mm-hmm. 3 days apart. There's BOFA buying 734 and there's BOFA selling.
And again, those are reports that are showing the actual entities, right? It's not like, I've spoken to guests before that it's kind of implied that it might be some of these entities, but of course,
right,
on some of those futures exchanges. But I mean, obviously here we can see exactly who it is.
Yes, right. That's a good point. On some of the reports, like the commitment of traders, you have a listing of total number of contracts, and it'll be like the 8 top entities that own those contracts. But here on the issues and stops report, this is why I watch these close, is there's a name and there's an amount and there's a date, and that's pretty definitive. And that's why this particular example is very penetrating on what went on. So BOFA's a new player in metal, oddly enough. In fact, they hadn't bought or sold anything on Comex until about a year and a half ago. So here's of all their Comex trades, or settlements, not trades. They may have been trading metal, but they weren't buying it on the issues and stop statements. They were not accepting metal or selling real metals. They might have been trading contracts. So about a year and a half ago, they went on a buying binge and they had got up to about 25 million ounces. So this is that date when my hypothesis is JP Morgan went to BOFA and said, oh, we got 25 million ounces of shorts and I see what you've got in the vault there. Can you take care of this dirty work for us? And bam, they sold it all. And since then, they've been on a buying binge even more so, and they have recovered it and then some. So that's a pretty interesting incident. So I'm calling this out because it's in this, what I'm calling a new era of a dearth of metal. It's not like it was in July of 2020, where JP Morgan is clicking the mass and moving 30 million ounces. It's just not that way anymore, is my interpretation. Okay. So to move on to another incident, and I might say there's been plenty of smaller things. I'm giving you 2 of these.
The high level overview
significant
stuff. Yeah.
Yes. I mean, in fact, it's routine anymore where if JP Morgan is selling metal, you can see there's a time lapse. Like you saw in that July 2021 where they did it that first day. Bam, first notice day, metal moved, they issued delivery notices, done deal. And now they're waiting into the middle part of the delivery period and they're rummaging around to come up with a couple million ounces and then they settle, it seems. So, okay, but this example just tops everything. So we're talking a March contract. So that's the red line here. All during this period here, when it's the front month contract, it's actually the open interest is running low to trend. And then you start into the roll period and it's still low. And you come down here into the final 7 days, and let's zoom in. And so also in this period, this final 7 days, you're coming into the run up to the Russian invasion. Mm-hmm. So you've got that superimposed on top of this. So in fact, that might have been the worst case scenario for anybody, any Comex player that wants to contain prices, that happened so close to first notice day on an active month. That happened on an active month on silver. It would have been really interesting if it happened to an active month on gold, but it happened on silver. Generally, the active months on gold and silver are alternating. So you're coming in here, and all of a sudden, this March contract that was below trend is suddenly on trend. And then you come on to the February 23rd report, and it's actually above trend, and it's tracking right on with this blue one here, the July 2021, that one that was epic and delivered 82 million ounces. So I'm watching it closely, and the February 24th report comes out. The preliminary, Comex reports a preliminary around midnight, and then about 10 hours later, they report the final one. Okay, so that February 24th report comes out, the preliminary, and it is over the July 2020 contract, a little bit over. Basically, it's tracking on top of it. But as compared to that month, now I think I showed you earlier, there's a lot less metal in the vault now. I mean, you're done at 16,000 contracts. So you're done at T-minus 1 day, and the amount of open interest on a contract that goes into delivery in 1 day is far above what's the amount of metal in the vault. So this was precarious. So this was worse than the July 2020, which at 1 day till. So I was on the edge of my seat, and then the final one, 10 hours later, the final report comes out, and it is marked down by 6,700 contracts. That's an enormous adjustment. I'll speak to that in a minute. Mm-hmm. But it looked, and it happened to be, if this was a manufactured number, it just happened to be a smidge below the amount of metal in the vault, this psychologically important number. So even at T-minus 1 day, with 1 day left on trading, that somebody could wipe their brow and say, well, I guess they made it through the limbo game this time at Comex Silver. But so you could discuss whether that was a manufactured number, and I speculate it was. So it's even worse than that 6,700, because not only did the March contract number get marked down by an enormous amount, even the next active month, 2 months ahead, the May contract got marked down a lot also, 1,350 contracts. So the sum total of all of them were 8,100 contract reduction. And that's never been seen before. Those are just enormous. So there's a good friend at Wall Street Silver that I've met through there, who goes by Exploring Finance, that is a real data geek, and he's fortunately kept most of the preliminary reports, whereas I was only keeping the final ones. And so he writes for Wall Street Silver, and also contributes at Shift Gold. You can see his work in both places. So with those statistics, the two of us compiled that with those the preliminary and the final OIs, we compiled the stats on those. So here's normally, as you can see, the change in OI between a preliminary and a final report, it averages about 100, and they've been as low as a 1,660 reduction and as high as a 1,280 gain, but the average is generally just punk. It's only down about 100. And on the February one, you're down 6,700. And the 2 months in advance, which I had filtered this data, so we're only looking at the front month contract. So this wasn't the front month contract that's not on here, the May one. But even if it was, it would be still way beyond almost everything except one other point there on that reduction. Mm-hmm. And it's even worse than that, because this February, the March contract one came in the last 2 days of the contract, where the open interest is greatly diminished. So that 6,700 reduction in that open interest for that contract, percentage-wise, was 30%. So if you do those stats on a percentage basis, it's just unbelievable, literally unbelievable that could happen. Mm-hmm. So the average reduction is about 1.5%. They've been as high as a minus 2.5% reduction. In that March contract, one was minus 30. So if you're a stats geek, that's a sigma 83 event. That's 83 standard deviations from the mean, or data points. This little tick here,
and
can't happen.
Towards your earlier point that we kind of touched on again, this is more, not looking at the price, but more looking at the behavior of the market to try and figure out what's going on, right?
Right. And I would add to that, it's beyond behavior. It's like the
outlier events.
Well, that's a nice way to phrase it, or you could say the manipulation or the outlier. You can decide which of those two it is. I'll go with the latter. Okay, but the story gets even better. All right, although I might add, that's the big story right there. Now, some of this other, the next couple of things are kind of tacked on,
and this
they're
is
not as
just to add too that this is still a fluid situation. This is something that is still evolving that we have yet to see basically the outcomes of, right?
Right. Yes. And I would add to that, it's all accumulating, just like we saw that. And it's accumulating from last or July 2020. So is this tension, the whole market builds in the tension. It's just getting to be a tougher and tougher situation. And apparently the bullion banks are just going to more and more extreme measures, is my interpretation. So then, so to reiterate, that was the big thing, is these stats here. But even going ahead into the next couple of weeks now, so that's about 2.5 weeks ago. But on the first notice day, this is what happened. There were only usually there's all these contracts standing for delivery, and bam, first day usually about half, 50 to 60% are settled. And the shorts just issue delivery notices, bam, it's done. So on this contract, though, it's different. So about 1,000 contracts stood for delivery, or were issued delivery notices. And that works out to only about 11.6%. So that was way less than usually occurs. And here's my explanation of that, is that, so as Comex statements are telling us, there were 8,500 contracts standing for delivery and nobody pre-settled. And then 1,000 were issued delivery notices, and that's our way below average, 11.6%. But here's my interpretation. What probably happened was there were the 8,500 on the Comex adjusted statement, but there were these 8,100 guys I don't have an explanation for that were probably settled in the shadows on early Friday morning. And so there probably would have been about 16,700. So if you apply the 50-60% number, you would come up with an expected number of contracts on first notice day of about 10,000. So you had about a 9,000 contract deficit on first notice day. And that just happens to pair up with this epic reduction of 8,100 contracts. That's quite a coincidence there. Okay, so there's more. And again, there's much more interpretation on this. So you got to get by. The big number is the 8,100 contract reduction that was unprecedented from preliminary to final. So if you think about it, then there's these 8,100 contracts that were there wanting metal, and possibly some deal was cut in the wee hours of Friday morning while at least all the Americans were sleeping. So people want metal, and they're probably, most of them are bankers, and they didn't get it. So that's why I call it the effective default. But they still want metal. Now, maybe if it was JP Morgan that was sequestered everybody to cut this deal to defer any further transactions of metal, then they would have done that. But the guys that were long still want metal. So look what happens here on that same month contract now over the next, I got 12 days on here. So usually after a contract goes on the first notice day, there's actually generally a few closings of contracts. Some of the longs just fold and they settle. So actually the open interest falls. And then sometimes later in the month, other folks come back in and buy. And maybe by the end of it all, they average out that it's a net zero. In the highest months, you might get another 600 or 700 contracts come in. But in this March contract, and under the hypothesis, there's a lot of folks starved of metal, maybe, and they re-enter the contract about a week later, and they just buy metal. And about 200 contracts got snapped up in the week or so after. Mm-hmm. So maybe that was some of the same longs that got stiffed. Or it was a different marketplace also because this Russian invasion was going on. And the market was spooked, and maybe there was a change of perception, and a lot of folks were in here. Other folks trying to buy metal. Either interpretation, but regardless, it tends to support the idea that folks did not get their metal on first notice day.
Mm-hmm. Yeah, and that is, I think one of the most dramatic charts there, right?
Yeah, right. That's one of those lines is not like the other. Okay, then on if you look back over a dozen years or so, if I just filter in the banks and look at how much metal they've bought and sold, issued and stopped, you get this plot. So here's the March to date. And so even if you believe my hypothesis that 8,100 contracts settled elsewhere, and they were mostly bankers, there still were 4,500 contracts bought metal by the bankers since. So even this is almost guaranteeing you that the bankers were very interested in buying metal for the March month. So at least 4,500 contracts wanted, plus if the 8,100, any of those, if that hypothesis is correct, they wanted metal too. But the point of this plot is that this is one of the highest months of bank activity on buying contracts. And BOF has been leading a charge on that. They bought about 60% of them. So if you look at the other side of the transaction, the number of shorts issued is about 4,100. And it's mostly JP Morgan. They're there by themselves practically, mm-hmm. trying to contain the market. And they're the ones that seem to be defending silver prices right now and possibly running out of metal while they do it. So here's, if you want to call this the interpretation of the hypothesis. So when you were come down to one day to first notice day, the OI trend was just on track to exceed Comex registered. So it looked like there might be some level of a default that could happen, what I'll call an effective default. And it's almost certain there is no bullion bank out there anymore that has the kind of metal hanging around, just sitting in Comex vaults is eligible. They can click the mouse and transfer. I think those days are over. And so they probably knew that. And stacked on top of that was the Russian invasion was in progress and getting started. And the markets were very tense. And the banks, in this hypothesis, did not want to go into the last day of trading before first notice day and have even more long stand for delivery, because that would energize the market. So I suspect that the bullion banks, plus maybe some of their big inside players, they got together on that Friday morning somewhere between when that preliminary report was generated and the final one. So that happens from about Friday night. And there were probably 8,100 contracts or so represented in the room. And there were too many longs than shorts. But they paired the March contracts with each other. I'm hacking this up here. I'm not being very clear on it, but they took the shorts and they paired up with the longs and they settled on the March contract. And so it's an off exchange transaction. What the terms were, I don't know. It would be just like an OTC trade. Mm-hmm. So then there were still an extra 1,350 or so longs that were unpaired. So I'm speculating they paired those longs with shorts from the upcoming incumbent contract in May. And they had those folks settled with the same bankers that had May contracts that were open, and they just paired them off. Again, it was under terms similar to an OTC transaction. And so the sum total was 3,100 contracts were settled. And no, you could ask yourself, well, why didn't they just do this on the next trading day? Because if you watch typical trading in the last few days, there's plenty of these exchange for physical trades that go on in the last days. And I suspect it's the bankers that just settle elsewhere over in London is a OTC transaction, and they settle amongst themselves. So the benefit for them is they were able to manipulate price and open interest on that contract as it's coming down, but then they just go and settle over in London. OTC trades the settlement terms are invisible. So they did that. They settled on that Friday night before because they wanted the stamp on the final print to show that the open interest was below the amount of metal in the vault for that last trading day. Because if they went into the last trading day and it looked like Comex default was coming, then a lot of folks could have piled in that contract because this war, the market was energized from the war, and I think they just wanted to avoid that. And they don't want to have the print also showing this enormous amount of OTC trades that went off that day. So that's the hypothesis.
Right. And that kind of comes back to the idea of what that signals to the market, right?
Right. And to me, my interpretation is the big guy is running is tight on metal, and it's JP Morgan. So here's that 11 dozen-year trend of the net amount of metal JP Morgan has bought on Comex. So this doesn't necessarily mean that's how much metal they've got in the vault, because they can move metal in or out, and these are just net trades. There's no report that's made that shows how much JP Morgan house account has in their vault at Comex vaults. You've got to surmise that from other data. So, but this is what they bought. So you can see from the bows, the depths of 2013, where they had a net negative 20 million ounces, they've gone up to, it was 108 here. So they added about 130 million ounces over those years. But that was the beginning of the big change, what I've proposed here, which occurred for that July contract. So there where they gave up the 30 million ounces in one fell swoop, they bled some more metal into the market over the next year or so. And now they've given up 17 million ounces for this March contract. So the sum total is they are off 61 million ounces from their glory days where they could click the mouse and move 30 million ounces of metal. So in between here, you saw what might have been, they went begging a Bank of America for them to settle 25 million ounces of shorts. I don't know that, but I think that. And now you've got issue and stops reports showing they did give up 17 million ounces here in March. So the big guy is quite depleted, I think.
Mm-hmm. And again,
the game is
just to just to say that again, from our kind of pre-interview chat there, that's not showing the actual metal that they have in the vault, right?
Right. Yeah,
That's just what they've traded on the Comex.
Right. And so they could have moved, for all I know, 10, 20 million ounces in. They could have moved 10 or 20 million ounces out. We don't know what they got in there. But if you look at the JP Morgan vault total ineligible right now, I don't have it in front of me, but it's about 142 million ounces, I think. But 102 million ounces of that we know is owned by SLV, because SLV makes a vault report, and they have, I think it's 6 vaults. One of them is in JP Morgan's vault in New York. That same one that reports it, that number gets rolled into the JP Morgan vault total. So that's 102 million ounces out of that 142 million ounces that's ineligible. So the absolute maximum JP Morgan could have with their name on it in their own vault is 40 million ounces. And then from there, subtract out whatever customer accounts own. And they have some big clients. So I'm sure some of their customers have large holdings ineligible. But that's the absolute maximum they could have, is 40 million ounces, although it happens to pair up with this net over the years. But I'm sure their stash is quite a bit less than 40 million.
Just to play devil's advocate, though, could they not add metal to the vault without reporting it, if they're not, basically having it registered like that?
With all vault movements are shown. They have all the vaults have a daily report that comes out. So if metal is added or removed, it'll show up in that report. But you don't know if it was for the house account or customer accounts.
Right. Okay.
So you just don't know. And JP Morgan customers, the activity there is enormous. If you took, actually, this would be interesting. I should do this. If you take all the bank house accounts and you add just JP Morgan customer accounts, that's probably 85% of Comex activity. That's a lot. So their customer accounts are enormous. So they're moving metal in and out of the vault. You never know for sure when that's coming in or going out if it's that Haas metal. I after watching it for all this time, of the belief, it's my conjecture, that when it comes in about 600,000 ounce pieces, which I call a truckload, that's about the amount of metal a Class 8 truck can move. And there is a lot of 600,000 ounce transfers to go in and out of Comex. So I call that the standard truckload. So usually when I'm looking at those reports, I'm thinking that those increments of a truckload are the house account. And they often pair up. Like if I see 600,000 ounces move into the vault, often you'll see it moved in and registered a day later. And then you'll see JP Morgan issue that same amount of delivery notices that same day. So you can kind of track it. You can track it backwards from the delivery notices in a lot of cases. So the net on that is, I think I can surmise house account movements, but I don't know that. Mm-hmm. You got to separate what you know from what you think you know.
Well, and that's what I appreciate about your analysis here, Michael, is that there's only some things we can say we know, and then the rest is implication. But like you say, there's a lot of data here that is very out of the ordinary, that will take a little bit of time to play out. And I think it's, as you say, like, it is worth paying attention to and at least being aware of at this point.
Yeah. Yeah. That's that body language behind the scenes. There's that hard data. Then you see this body language and you try to interpret it. But I just haven't heard anybody talk about this the way I've laid it out. So I'm open to alternative explanations, but at this point, there's a lot of things to explain that I don't see any explanation for. So it's worth watching.
Absolutely. Michael, there
will be another incident, I'll predict.
And hopefully some fireworks, as you've nicely put there. So tell us about your coming Substack.
Well, I've been doing this analytics for my own benefit and for the benefit of the folks at Wall Street Silver. It's like I said at the very beginning, you can't take the market signal from the price. And there were long periods where the price signal was just completely flat. But all of this was going behind the scenes. So I was doing a lot of this stuff for my own benefit, but I would post it usually daily on Wall Street Silver. And just so those folks knew to stay in the game. But along the way, I've done much more comprehensive analysis where I built a half dozen fairly complex models, economic related. I'd rather not say what they are now because I don't want to get scooped.
Talked about some of them, and they're quite interesting. And I mean, the depth of your work and your research here is very evident. So I'm looking forward to seeing what some of those models show us and how they relate to some of the things we've touched on the show as well.
Right. So what's coming to Substack won't be like this, although it might include things like this, but it'll be much more complex models on what's going on with government budgets and oil production linked to gold and things of such. So I think it'll be high value.
Absolutely. Well, Michael, I want to thank you very much for sharing this research with us. Of course, anybody can go back and read, months and months worth of research and reports like this that you've written up at Ditch the Deep State on Wall Street Silver. Just a Google search away, and we'll look forward to your Substack.
Okay, and thanks for inviting me on. I had a good time.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.